When I started trading in 2013, I lost 92% of my capital in my first 3 months. And it was not until I learned these 5 rules that everything changed. Swing trading can be challenging, but after 10 plus years of trading, I can confirm that these 5 rules are the key to finding success in trading. These are the same rules that transform me from being a losing trader into a profitable trader, and they can do the same for you, whether you are a beginner or have experience in trading. Hi, my name is Dennis Kirui, and I'm a full-time trader with 10 plus years of experience. You will find my verified track records below, showing how I turned from being a losing trader into a professional trader. To better be able to understand these 5 rules, we will use the analogy of driving a car. Let's start with the first rule of driving safely in the trading road. You might overlook this, but it is crucial for your survival in trading. Whenever you want to drive a car, you usually advise to fasten your seatbelt before you start driving. No matter how skilled you are as a driver, wearing a seatbelt will protect you from possible injury in case of an accident. And in trading, the seatbelt is never risking more than 1% of your trading capital in any one trade. This first rule ensures that even if you get into a series of losing trades, you won't blow up your trading account and have to quit trading. For example, if you have $1,000 on your trading account, with this rule, you shouldn't risk more than $10 in any one trade. But while protecting your capital is important, trading in the wrong direction can lead to disaster. So how can you know whether you should buy or sell a particular market? I'll share my story from 2020. In the first 3 months of 2020, I was up 21% in profit. But unfortunately, for the next 1 year, I kept losing money. So what was the problem? I didn't know how to identify when the long-term trend of a particular market actually changes. And I found myself buying a market when ideally I should have been selling, or selling a market when ideally I should have been buying it. And in trading, the second rule is that you should ensure that all your trades always align with the long-term trend of a particular market. This long-term trend is ideally determined by using the daily and weekly chart time frame of a particular market, and then making sure that whatever trade you are placing, it is in line with what is happening on the daily chart or on the weekly chart time frame. I personally use an indicator called the exponential moving average indicator, or the EMA indicator. For example, if the 5-period exponential moving average, or EMA, is above the 21-period EMA for the last 3 weeks, then I consider that the market is actually bullish. And if the 5-period exponential moving average is below the 21-period exponential moving average, then I consider that market is actually bearish. Whenever the market is bullish, you only place buy trades, and whenever it is bearish, you only place selling trades to short the market. This trading with the trend increases the probability of success for your trades, and this is because you are trading in the overall direction of the market where there is actually momentum. But before we look at the third rule that helps to ensure that you avoid unnecessary losses, I would like to share with you a free training that I created on the 7 steps to financial freedom through trading. It is an amazing training that will give you a solid step-by-step plan on how you can start trading for a living. If this sounds interesting to you, then sign up for the training using the link in the pinned comment of this particular video or in the video description. But while trading with the long-term trend will help you, market conditions usually change rapidly. So how can you be able to protect your trades when markets are very volatile? Back to our car example, whenever you are driving a car, you always adjust your speed based on the road conditions. When it is raining and it is slippery, you slow down, but when it is sunny and you are on a highway, then you drive a bit faster. And it is the same in trading. A common mistake new traders make is using the same stop loss distance for all their trades. For example, placing all your trades with a 30 pip stop loss, regardless of market volatility. But the best way to avoid losing your money unnecessarily in trading is by basing your stop loss on market volatility. And I achieve this by using an indicator called the average true range indicator, or the ATR indicator. And I measure volatility using this indicator over the last 10 days of any particular market. For example, if the average true range of a particular market is 20 pips on that particular day, then I set my stop loss as a multiple of that ATR value. It can be 80% of it or 1.2 times based on your backtest. I will link a video in the description of this particular video that will show you how to use the ATR indicator to manage risk in trading. But even all these 3 rules are still not enough to become a profitable trader. Most traders usually find it difficult to determine when they should close a trade to be able to take their profits. They either let their fear guide them to determine when they should close a trade, or due to greed, they turn profitable trades into losing trades. Imagine you want to drive to visit a friend who lives in a new place that you've never visited before. The next logical thing for you to be able to do is to open your Google Maps, set the location, and then follow the Google Maps to lead you to where they actually stay. Doing this prevents you from getting lost along the way and keeps you on track towards getting to your friend's home. And it is the same in trading. I have found it helpful to set my profit target at 2 times my stop loss distance. So if I set my stop loss distance, let's say at 50 pips, I set then my take profit at 100 pips out. This ensures that I have a good balance between the risk of the trade and the potential reward of that particular trade. And by targeting to always make 2 times the amount of risk that I am taking in any one trade, it helps me to be able to recover faster whenever I lose money and helps me to become profitable much faster. But while setting realistic profit targets is important, there is one more crucial aspect of trading that can make or break your trading strategy. So what is this common mistake that many traders make? Let's look at this example. When driving a car, you're usually advised to not overload it with either too many passengers or too much luggage. If you ignore this law, you will either get fined by the police, or if you lose control of your car, then it will become very dangerous for the passengers who are actually in your car to be safe. And in trading, this relates to how many open trades that you are holding at any one time. I have found it helpful to limit the number of trades that I am holding to a maximum of 6 trades at any one time. And it is important that these 6 trades are not in correlated markets to avoid doubling your risk in the same trade idea. This will prevent you from being overexposed whenever there are large price fluctuations in the market that could cause you to lose money much faster because you are trading in the same idea. This is how I apply this rule in my own trading across the various asset classes that I place. I never place more than 1 forex trade, 1 metal trade, 1 crypto trade, 1 index trade like in Nasdaq, and for stocks, I don't enter more than the maximum of the 6 trades at any one time. This means that when I am risking 1% per trade across the 6 trades, I am only risking a total of 6% of my account at any one time, with the potential of making 12%, that is 2 times my total risk. While these 5 rules are important, they are just the foundation. If you want to fast track your path to becoming a profitable trader, then check out the video on your screen. You will learn how you can master trading fast and save yourself years of trial and error that I actually went through. So see you in the next video.